Zacks Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. Well, in this particular piece, you're going to know all you need to know about put option writing. And the person who's going to explain it to you is right here with me, Kevin Matris, who is our top options technician here at Zacks.com. He has many titles here at Zacks.com. Stock screener, options technician, technical market analysis. You do it all.
I like them all.
I tell you, it never ceases to amaze me is how many hats you wear here. Put option writing is seldom talked about strategy, I think, but I'm under the impression it's a strategy that's very popular with professional investors and especially seasoned options traders.
Right. You know, a lot of professional traders like to use this strategy. It's very popular, but what's interesting is that really anybody can do it. So I figured in today's piece, to illustrate this, I was going to go over an actual trade of mine that I did, kind of walk you through how it works. You can see how you make money, and I think this will help kind of crystallize how this whole strategy takes place.
Okay.
So since we are talking about puts, though, let me just see if I can do a quick review.
Sure.
A put option in general, you make money on a put option, or I should say the put option will increase in value as the price of a stock goes down. Now there's two sides of any options trade, so check this out. A put option gives the buyer the right but not the obligation to sell a stock, typically 100 shares, at a certain price within a set period of time. The put buyer pays a premium for this right. Now the put seller, or the writer, that person is obligated to buy that stock at a certain price within that same set period of time. And the put writer collects a premium for this obligation to potentially have to buy this stock. The benefits of writing a put option is that if you write a put option, let's say an out-of-the-money put option, and it goes down, but not as far down as your strike price, your profit is going to be the entire premium that you got paid for writing it in the first place. Also, too, the other benefit is that if it does go down to your strike price and that stock is put to you, if you wouldn't mind owning it anyways, you now have the ability of owning that stock at a cheaper price. And the real benefit, too, is that while you now have that stock at a cheaper price, you also got paid the put premium in the meantime. Now, there are some risks, though. The risk, of course, is that if the stock goes down far enough and you decide you don't want that stock at that price, you're going to have to buy that put option back at a higher price, which means that is how you can potentially lose on the trade. Or the stock could be put to you at that price. So you may be forced to buy that stock at a higher price, which is above the market, and of course you're going to have a loss on that stock trade. But the thing that's interesting is that you have the ability of collecting this premium pretty much regardless of what happens.
So let's just review a couple of things here. In this example that you just gave, you are the put writer.
That is right.
Correct? And so, and because on the surface this can sound a little complicated, I just wanted to clarify. You're getting paid to write a put option.
That is right.
You may have to buy that stock later, but you're still getting paid to write the put, correct?
That is correct.
Okay, I think I've got it. Sounds like you're talking, or taking on rather, the same kind of potential risk as a normal stock trade, though.
You really are, because if you do have that stock put to you, you're basically just owning that stock like you normally would if you had purchased it outright. So there isn't anything, scary or nutty about a strategy like this. I know it's new, and people always wonder, how can I get hurt on this? But you're really just buying the stock. So yeah, it's virtually the same kind of risk there.
All right, let's look at the trade step by step.
Okay, the trade is this. On December 3rd, I have a slide up here. On December 3rd of 2008, I decided to write a put option on Apple Computer, ticker symbol AAPL. And I chose the April out-of-the-money $70 put option at a premium of $835 or $835.
Okay.
Apple at the time was selling at approximately $93, and I believed Apple was going to go higher, or at the very least, I didn't think it was going to go down much below 70 bucks. So if you look at this chart, This shows you where Apple was on December 3rd, and that horizontal line you can see at 70 bucks, that is where I wanted to see Apple stay above, and that is where I would be I would be able to see the maximum profit potential.
Okay.
So the thing that's interesting is that while I liked Apple, I didn't have enough conviction that it was going to go straight up, because don't forget, we were in the full swing of the bear market, and I wasn't willing to put up 9,300 bucks to actually get into 100 shares of Apple. The other thing too, though, is I didn't want to miss out on this opportunity because I thought I had correctly identified a range, and I wanted to make sure that I could profit from it. But even if this trade were to go down, I thought to myself, hey, if I were able to get Apple at 70 bucks, that's a great place to get Apple, especially considering it was at $93 at the time, and I still would have gotten paid a premium for my effort. So I liked the trade, and I decided to, on December 3rd, to write the April $70 put at $8.35, which means as long as Apple stayed above $70 at expiration, which is the third Friday of April, I would have made 835 bucks. Now, what's interesting about this trade is this. If the market went below $70, I still would not have lost money. I just would not have made as much. In fact, the price could have gotten even as low as $61.65, and I still wouldn't have lost anything. And here's why. Check out the slide. If Apple went to $61.65 and I got the stock at 70 bucks, I now have an $8.35 loss. However, I collected an $8.35 premium for writing the put, which means even though the stock was below my $70 purchase price, the premium that I got for writing the put offset my stock loss, so I was even on the trade.
Okay.
So, as long as Apple stayed above 70, that's my maximum profit zone, and even if it went to 61.65, I still haven't lost any money. I think that's a pretty good deal.
Sounds interesting. I
Yes.
think I've got it.
Well, check this out. Since the time I placed that trade, the price of Apple got as high as $124.25 and got as low as $78.20. Now, to wrap up this trade, let me see if I can summarize it. On 4/17/09, that $70 April put option expired worthless, which means my profit was the full $835 premium that I collected, less my $10.75 commission, so my profit on that trade was 98.7%. Now, in hindsight, let me just say, Apple did get as high as $124. So if I had purchased that stock when it was at 93, in theory, I could have made 31 bucks or $3,100. But before it got to $124.25, the stock actually traded as low as $78.20. And if I had that stock and I was in it from 93 to $78.20, that would have been a $1,480 loss, or a 16% loss, which means I would have been forced to make a decision, should I hang on to the stock or not? Knowing I was down 16%, I likely would have gotten out of it, which probably means I got out at a loss and I never would have gotten back in, which means I would not have been there for the run-up. So with the written put option, though, this was a very easy trade because I never found myself in a difficult position from the very first day I put it on. Even when the market was coming down, my position was never in jeopardy and I never had to think twice about it. This trade turned out to be a virtually picture-perfect trade, and the thing that's so interesting is that anybody can do this because it's just so easy.
And again, just to clarify, do you own the underlying stock?
At the moment, I don't have Apple, but I did just recently write another option. I ended up writing a ratio spread. That maximum payout, I believe, is $1,300 bucks. That's going to come due in 4 weeks, so I'll make sure to come back in 4 weeks and explain that one as well.
All right, don't put all your apples in one basket,
There you
whatever
go.
you do. And if you want to consult with a text version of this piece, you can do so on the homepage of Zacks.com. Just scroll down the page until you get to the Know Your Options section of the homepage. And don't forget, when you consult on options with Kevin's articles and videos, you too can know your options. With Kevin Matris, I'm Terry Ruffalo.